Hi friends, in this video we are going to study fourth question of the 2019 Hnda Financial Management past paper. This question evaluates valuation section. If you think this video is useful, please give a like, share with your friends, and if there are any doubts on this question, you can ask through comment section. And subscribe this channel with click the bell button for getting the notification of the forthcoming videos. Okay, let's go to the video. The first, list out 4 common bases for valuing shares. There are 4 common bases. Those are assets based, dividend based, earnings based, cash flow based. These are the based for valuing shares. ABC PLC pays a dividend of ₹2 per share currently. The company is expected to maintain a 30% dividend growth rate for the next 3 years and then keep an average growth rate of 6% forever. If the required rate of return on ABC PLC stocks is 13%, what will be the value of a share of ABC PLC? Now we have to calculate the value of a share of ABC PLC. So as per the question, dividend of ₹2 per share currently. So D note is given ₹2. And first 3 years growth rate is given 30%. Growth rate 30%. First 3 years. For the first 3 years, 30% growth rate. After that, growth rate is 6% forever. So growth rate 4th year onwards. And the required rate of return is 13%. So R equal 13% is given in the question. Now we have to calculate the dividends for the years. So first, year 1, D1 equal D naught 1 plus G. So D naught is given ₹2 into 1 plus G. 1 plus G for the first year's growth rate is 30%. So 0.30. So answer for the D1 is ₹2.6. In the year 2, D2 equal D1 into 1 plus G. D1 equal already calculated ₹2.6 into 1 plus G G equal 30%. So the answer for the D2 is 3.38 rupees. In the year 3, D3, D2 into 1 plus G. D2 already calculated, 3.38 rupees into 1 plus G. G equal 30%, 0.30. So answer for the D3 is 4.394 rupees. Now we have to calculate P4. Now we have to calculate P3. P3 equation for the equation to calculate the P3. D3 into 1 plus G divided by KE minus G. Therefore D3 already calculated, 4.39 rupees. So D3 already calculated, 4.394 rupees into 1 plus G, 1 plus G. Fourth year onward, 6%. First 3 years growth rate is 30%. So we have calculated for the first 3 years, each year 30% growth rate. After that, fourth year onwards, the growth rate is changed as 6%. That is concerned from the fourth year. So 6%, 0.06. Divided by KE minus G. KE R equal 30%, 13%. So 0.13 minus G, growth rate 6%, so 0.06. So the answer for the P3 stock value in the third year ₹66.54. Now we have to find the present value for the cash flows. Year cash flows, cost of capital at 13%, present value. So year 0, there are no any cash flows in the year 0, so 0. Cost of capital 1 divided by 1 plus R. R is 0.13 upon N 0. So the answer is 1. We have to change in 3 decimals. So cash flow into cost of capital, present value 0. In year 1, cash flow we have calculated 2.6 rupees. So 1 divided by 1 plus R, 1.13 upon 2, 0.783. So present value in the year 1 2.04. Cash flow in the year 1 we have already calculated 2.6 dividend. Cost of capital 1 divided by 1.13 upon 1, 0.885. So present value in the year 1 2.30. In the year 2, cash flow in the year 2 we have already calculated 3.38 rupees. Cost of capital in year 2 1 divided by 1.13 upon 2, 0.783. So the present value for the third year 2.65 rupees. In the third year, cash flow 4.394 rupees. Cost of capital at 13%, 1 divided by 1 plus R, 1.13 upon 3, the 3 decimals, 3.05 rupees present value in the third year. And finally we have to calculate P3, stock value in the third year. We have already calculated 66 rupees 54 cents. So same cost of capital third year, present value 46.11 rupees. So the total present value is 54.11 rupees. This is the answer. Next, Senaga PLC has issued 100,000 of ordinary shares at a rate of rupees 20 per share, and the current market price of a share is rupees 25. During this period, company has earned rupees 1.2 million, out of which rupees 400,000 has been paid as dividends for ordinary shares, and rupees 200,000 has been paid as dividends for preference shares. The ROE, return on equity ratio, is 25%. A. Compute the dividends growth rate. G. Using RB model, RN model or RB model. The additional information: G equal RB, where R equal ROE, return on equity, and B equal retention ratio. B, we have to calculate the cost of an ordinary share using dividend growth model. So first we have to calculate the G, growth rate, dividend growth rate, as per the information in the question. Senaga PLC. So third, A. First we have to calculate the EPS, earning per share. EPS equal, earning per share equal net profit or profit after taxation minus preference share dividend divided by number of shares, number of ordinary shares, or weighted average of ordinary shares. So first we have to calculate, first we have to find profit after taxation. Profit after taxation as per the question, 1.2 million. $1.2 million. Preference share dividend $200,000. Number of shares, number of ordinary shares, is given in the question as 100,000 of ordinary shares. So now we can calculate the EPS, earning per share. Profit after taxation 1.2 million minus preference share dividend 200,000 divided by number of ordinary shares 100,000. So answer for the earning per share is rupees 10. After that, we have to calculate dividend payout ratio. Dividend payout ratio. Dividend payout ratio equal dividend per share, dividend per ordinary share dividend per ordinary share divided by earning per share into 100. Into 100. This is the equation for calculating dividend payout ratio. Now we have to find dividend per ordinary share. Dividend per ordinary share equal, in the question, total dividend for ordinary shares divided by number of ordinary shares. So total dividend for ordinary shares is given in the question as 400,000 divided by number of ordinary shares also given in the question 100,000. So dividend per ordinary share is rupees 4. Earning per share EPS is already given. EPS is already calculated above as rupees 10. So now we can calculate dividend payout ratio. Dividend per ordinary share is rupees 4 divided by EPS rupees 10 rupees into 100 rupees into 100%. So answer for the dividend payout ratio is 40%. 40%. Now we can find the RB model, the growth rate. RB model G equal retention ratio into return on equity. How to calculate the retention ratio? Retention ratio equal one minus dividend payout ratio. Minus dividend payout ratio. So 1 minus dividend payout ratio is already calculated as 14%. So 14%. So the answer is retention ratio is 60%. Now we can calculate the RP model. Retention ratio is calculated as 60% into ROE. ROE is given in the question as 25%. So 60% into 25%. 60% into 25%. The answer is 15%. This is answer for the RB model. The growth rate is 15%. The answer for the A part. The B part answer. B part answer. Calculate the cost of an ordinary share using dividend growth model. Now we are moving to B part of the question. The question is calculate the cost of ordinary share using dividend growth model. So now we have to calculate the cost of ordinary share using the dividend growth model. So we know already studied in the cost of capital section ordinary share capital, how to calculate the cost of ordinary share capital. We can calculate the cost of ordinary share capital through this equation. D naught into 1 plus G divided by P naught plus growth rate. Otherwise we can calculate through this equation D1 divided by P naught plus growth rate. So here D1 is given dividend for the ordinary share 4 rupees. Growth rate is given through the, we have calculated through the RB model, 15%. P naught also given in the question as rupees 25. Current market price of the share, market value of the share is 25 rupees. So now we can calculate the KE, cost of ordinary share capital, through this equation. ₹4 into 1 plus G, growth rate is 15%, so 0.15 divided by P naught, market value of the ordinary share is 25 rupees plus growth rate 0.15, 15%. So 4 into 1.15 divided by 25 plus 0.15. We can change in percentage, 33.4%. This is the answer for the B part question to calculate the cost of ordinary share capital. The fourth part, a bond has face value I, value of ₹1000, coupon rate of 12% and maturity of 5 years, and pays interest half yearly, so semi-annually. Calculate the prices of bonds if the required rate of return is 10%. So fourth part, we have to calculate the bond value the coupon payment is semi-annually. So through this equation we can calculate the bond value. B naught equal C divided by 2 into annuity factor. Close bracket plus FB divided discount factor. This is the equation to calculate the bond value. The coupon rate is semi-annually. Here C equal, we know the coupon payment. In this question, the coupon payment, the interest is paid half yearly. So this is semi-annual bond. First we have to calculate the coupon payment. Coupon rate of 12%. Face value of the bond 1000 rupees. So 1000 into 12 rupees, 12%. 1000 into 12%. So the answer C equal 120 rupees. 120. Here we have to calculate C divided by 2, half C, because the interest is paid semi-annual. So half C divided by 2 equal 60 rupees. The annuity factor. Annuity factor for the semi-annual bond is 1 minus 1 plus R divided 2 upon minus N divided R minus 2. This is the equation for calculating annuity factor for the semi-annual bond. Here our required rate of return is 10%. So 0.10. Number of period, majority period is 10 years. So minus 10. Required rate of return 10%. So the answer is 1 minus 1.1 1.05 upon minus 10 0.10 divided by 2, 0.05. So the answer is 7.72173. The FB face value equal 1000 rupees, that is given in the question. Discount factor equal 1 plus R divided 2 upon N. Therefore one plus R 0.10 divided 2 upon N, 10 years. So the answer is 1.05 1.6289. So now we can calculate the bond value through this equation. C2 already calculated as 60 rupees into annuity factor already calculated 7.72173 plus FB face value 1000 rupees divided by discount factor already calculated 1.6289. Now we can find the final answer for the bond. So value for the bond is 1077 rupees 0.2 cents. 22 cents. So the final part of the question is, you are thinking of carrying XPLC's preference share and par value of each share is ₹100. Per preference share will pay a dividend of 12% perpetually. What price should you pay for the preference share if you are expecting a return of 10%? This is related preference share valuation. As per the question, this information is given. Par value of the preference share is 100 rupees. The fifth question. Now we can find through this equation to calculate the stock value, preference stock value. P0 equal D1 divided by KP. Here P0 equal value of the preference share, D1 equal dividend of preference share, that is given dividend percentage 12%. Par value of the preference share is 100 rupees. So equal par value of preference share into dividend percentage. Par value of the preference share is 100 rupees. Dividend percentage 12%. So the answer for the D1 is 12 rupees. And KP, cost of preference share is given in the question. KP is 10%, expecting rate of return 10%. So now we can find the answer. Value of the preference share capital, D1 12 rupees divided 10% cost of preference share. So the answer is 12 divided by 10%, 120 rupees. This is the answer, value of the preference share.